Hey, everybody. Welcome back to the HBF Venture Accelerator podcast. Today, Hassan and I are talking about something that every startup founder worries about: how to raise venture capital. We'll break down what investors are really looking for and how to build enough traction to get funded. Raising venture capital is often seen as the big goal for startups, but how likely is it to actually happen? Is it as really hard as everyone says?
Well, the short answer is yes. The statistics can be quite discouraging for founders. It's often cited that only about 0.05% of startups actually receive venture capital funding. That's roughly one in every 2,000. So, not the best odds. And the reason is that VCs are seeing hundreds, even thousands of pitches a year, and they only invest in a handful. So, just getting in front of them is a big hurdle, actually. And most of the time, it actually happens to a warm introduction. There's traction which investors want to see. What they want to see is that people actually want what you're building. It could be users, revenue growth, some signal that says, hey, this is working. And they're in the business of filtering out a lot of companies towards finding what works. So traction is one of a big sort of signal and filter that they can use to figure out if this particular startup has an idea that is working. They care a lot about the team as well. So, are you the right people to solve this problem? Do you have any unique insights or strong founder market fit? For example, if you're building something in the fashion space, do you come from a background in fashion? Do you care about fashion? Do you have a history that could point towards you having some insights that could allow you to do a really good job at building a solution? Market size is another big one. So, like VCs want to fund big ideas and they want to fund big companies that have the potential to be billion-dollar exits for them. So even if your product is great, if it's not in a big or growing market, VCs aren't usually interested. And one thing that's often underrated is storytelling. VCs are investing in a vision for the future. So, and they don't actually know what that future looks like, and they want a founder or an entrepreneur to convince them about that future. So being able to clearly explain your vision, why now is the right time to build it, and what makes you different, this can really set you apart when it comes to fundraising. And the key thing to understand about these odds that we talked about, which is like less than 1% success chances, is that the VC system isn't really flawed or broken. It's just designed for certain types of businesses. VCs aren't in the game to fund good companies. They're only looking to fund outliers that can help them make $1 billion exit, or exit many times the amount of capital that they invested in the business. And so they're optimizing for exactly that, for those $1 billion outcomes. And they're not only looking for solid businesses. And the funnel to get funded, right? Like first it's getting an introduction, going through the fundraising process with the VC, then actually getting that check even at a seed stage is extremely narrow. So you need to focus on exceptional differentiation and execution. However, if you have a strong team and you have a compelling idea and can demonstrate early traction, your chances significantly improve.
VCs chase unicorns, so unless you truly stand out, you're likely not in the 0.05%. Are there any demographic or experiential factors that at play that might influence a company's likelihood of securing investment? For instance, does being a first-time founder versus a repeat founder, or a Stanford graduate versus a Midwest college graduate statistically impact a VC's decision?
Yeah, so there's clear evidence that these factors can play a significant role, reflecting both perceived risk and sort of network advantages. There's first we have repeat founders, right? So particularly anybody who has done a successful exit in the past, VCs think of them as a successful candidate to invest in because they've seen that whole journey. So data from Harvard Business School suggests that anybody who has a successful venture exit has a higher chance of succeeding in their next venture. Uh, After that are people who've actually had a failed chance before because they're still more aware about it. And the worst sort of chance of success between these three groups are first-time founders. So VCs are aware of that. VCs often see a successful exit as a strong signal of skill and execution. Also, when it comes to sort of university backgrounds, there's not a direct guarantee, but it often sort of correlates with access and network. So a study by PitchBook actually revealed that Stanford University, UC Berkeley, MIT, Harvard collectively accounted for nearly 25% or a quarter of all venture-backed companies, right? Like this is a way more larger share of venture-backed companies than this is a share of sort of university graduates in the US. So there is a network effect at play because these folks are able to get into those right conversations and be able to meet the right folks needed to get funding. And another stat that's also interesting is that Berkeley graduates, so people who graduated from UC Berkeley, have founded more venture-backed companies than undergraduate alumni from any other university in the world. So there is this access component to it, but it's also linked to the fact that these universities are in California, where a lot of this industry is. So you just have a lot more chances of meeting investors and getting in front of VCs. This isn't necessarily about the quality of education alone, but rather about the whole entrepreneurial ecosystem, how your alumni networks come into play, and how early stage capital is often concentrated around these institutions. While an entrepreneur from a Midwest college could very well succeed, they may face a steeper climb in the initial network access component, and it requires somebody like that to have even stronger traction and be able to demonstrate product market fit to overcome these implicit biases. It's crucial to acknowledge, though, that talent is distributed everywhere, and there's great successful companies and founders built outside of these ecosystems all around the US and all around the world. And VCs are increasingly looking beyond these traditional networks. So there is a trend of more and more access increasing outside of this bubble. And even in the past, there's been unicorn companies, which are billion-dollar companies that have been created by founders from, universities all over the US and all over the world.
Successful repeat founders and grads from top law schools like Stanford and Berkeley have a clear edge, but talent can come from anywhere. It's all about proving yourself. What are VCs really looking for in a company, and how do these criteria align with a VC's own business goal?
So VCs are in the business of generating outsized returns for their limited partners, typically institutional investors or high net worth individuals. These are folks who have given VCs their own money or money from their institution to invest in startups and companies. The VC is looking to generate 10x or 100x return on their investment within a specific time frame, typically 7 to 10 years. So they're looking for companies with the potential for massive scale and a clear exit strategy. VCs typically look for massive, market potential. Is the target market large enough to support $1 billion company? They want to see a clear path to dominating a significant portion of that market. They want to invest in companies that can capture a significant share of a rapidly expanding or underserved market. So think about Uber when it first came out. It's actually growing really fast. It's capturing market share. It looks like it can disrupt an old, huge market, which is taxi ride hailing. So that's sort of the kind of space that VCs get most excited about. And they also invest as much in people as they invest in ideas. They look for founders with deep domain expertise, strong leadership, a complementary skill set within the founding team, and sort of a relentless drive. They also consider what really makes your product or service truly unique and hard to replicate. So this could be some type of proprietary technology, network effects, or a strong brand even. And a strong business model will also show how repeatable and efficient customer acquisition and growth process is beyond the revenue gains. So if you can show that you're able to make money, you're able to acquire customers and have a margin over there, or you're on track to show that over the long term you can build a good revenue model or business model on top of your startup, that's something that will attract VCs for sure. And the most important factor is traction. Really, all of these things are ways that VCs are looking at getting traction validation, because traction at the end of the day de-risks the investment from VCs, and it's evidence that the customers actually want to use the product.
All right, thank you so much. VCs back founders with big market, scalable ideas, unique advantages, strong teams, and proven traction for huge returns. How precisely does demonstrable traction influence a VC's investment decision? And what are some concrete examples of that?
So traction is essentially quantifiable evidence that your business idea has its own worth and is generating momentum, and that your hypothesis about market demand is correct. So what this means is that it's data that tells investors that people want what you're building. It validates your assumptions and de-risks the investment for VCs. The more traction you have, the more leverage you have in negotiations, and the more investable you become. There's many different types of tractions, but traction is what allows anybody in the world to stand up and say, VCs, look at my company, look at how well I'm doing, and VCs are going to look at you and are going to invest in your company, because traction at the end of the day is the key to unlocking venture capital. So I'll give you some examples of traction, which could be customer or user acquisition growth. So if people are interested in signing up for your product, they're willing to download the app, for example. Consistent month over month growth in active users or signups or customers. So if you're growing every month at a incremental rate of, let's say, 10% weekly, this is something that can be incredibly compelling for venture capitalists. For revenue generating businesses, it's pretty straightforward. If you're doubling your sales every quarter, or you're achieving specific monthly recurring revenue MRR milestones, like uh, or $1 million in ARR or annual recurring revenue, for example, these are really strong indicators if to VCs that people are willing to pay for your product, and that you're able to grow the number of people that are willing to pay for your product. It tells VCs that there's something there that they should invest in. Another thing that can be a good validation, especially at the pre-product stage, is pre-sales or pre-order. So if you can show a vision to a prospective customer and people are willing to give you a portion of that price upfront, that tells VCs that there's real demand for what you're building. And they also look, VCs will look beyond just user numbers. They want to see how engaged those users are. This could be about how long they're using your app, or whether they're using it on a daily basis, or if they're active on a monthly basis. And how quickly are people adopting new features, or how likely are your existing customers to refer to you new customers. All of these are indicators that what you've built is something that generates demand and traction. At the end of the day, VCs want to see how well your product can solve a problem for the market. A well-received minimum viable product with positive user feedback, strong retention data, and low churn is ideal. And if you have organic growth where people are visiting your website and downloading what or using whatever service you're offering, that to the VCs shows that this is something that is getting some potential, that is getting demand. And if I can invest some capital into this business, this can grow and become a larger and bigger scalable company.
Thank you so much. So, from what I'm hearing, traction shows real demand, whether it's users, revenue, pre orders, or engagement. It's what makes VCs really take you seriously. But can traction be misleading? Are there examples where it might look good on paper, but not be really what VCs are truly looking for?
Absolutely. There can be misleading traction. VCs are sophisticated and look beyond surface level numbers. Some examples of misleading traction could include, you have a lot of downloads of your app or a lot of website visitors, but they're not actually using the website or using the app really regularly. And, that doesn't translate into actual engagement or revenue. So this could be an example of misleading traction. A million downloads are meaningless if only a tiny fraction of those people are active users using the app on a weekly, monthly, or daily basis, depending on your use case. And this mostly happens when a founder is trying to get an inflated number of free users, but they're not able to solve a real problem for their users, so users don't really use the app after downloading it once. Similarly, if your initial traction came from a highly manual, expensive, or non-replicable effort, VCs will question your ability to scale. That's not to say that you can't be manual in the start, but you just have to be able to convince VCs that you can automate this and scale this operation. Big name clients are also another case where they're great, but if the revenue is low and the costs are high, VCs won't be impressed. It's all about how likely is your business to scale and how healthy are the economics, how much money can you make for the company over the long run. And that's what gets VCs excited about investing right now in the short run, to be able to be part of that growth in the long run. So a startup working with Coca-Cola but generating minimal revenue might signal issues with sort of scaling sales, or what the value that you're providing with the company, or the limited market opportunity. And in addition to this, like if your traction comes from custom development projects that aren't core to your scalable product, VCs might see this as a distraction rather than a validation of your primary business model, because VCs are looking for a scalable product or solution that they can easily invest capital in, and that can continue to grow and absorb more of that capital. So any sort of traction that shows interest but doesn't really prove towards the fact that this business is a scalable moneymaker or scalable revenues generating tool in the long term, VCs might doubt that traction.
VCs look past surface metrics. Traction must reflect genuine demand, sustainable growth, and alignment with a scalable business model. Can you give us some examples of companies that initially struggled to raise VC, but then by focusing on and achieving significant traction, were able to successfully secure substantial funding?
Yeah, so there's actually some really big companies that everybody knows about that were rejected by VCs a lot in the start. So Airbnb is a classic example. In its early days, the founders struggled significantly to raise seed funding. Founders struggled to raise even $150,000 seed round in 2008 and were rejected by many prominent VCs. Their initial concept didn't really resonate and they lacked significant user growth. But it was only after they focused on improving the user experience that they started seeing traction. They professionalized their photography to better showcase listings and demonstrated genuine initially slow user growth and bookings, particularly in a specific market like New York. And they started to gain momentum. And as the momentum increased, they attracted serious investors and ultimately secured significant venture capital. For a lot of startups, like the Airbnb example, this is a journey where you're trying to get some traction, then you go to VCs and see if your traction has bite from investors. Maybe your traction isn't good enough and you're iterating and changing your product and trying out new ideas. And eventually you find what your market or your users really want. That gets your traction going, and that's what gets venture capital invested and interested in your business. Another great example is Zoom, the video conferencing app. The founder faced skepticism from investors who felt like video conferencing market was really saturated. Uh, However, the founder started focusing on building a superior product with unparalleled reliability and ease of use compared to what was existing in the market. This intense focus on product quality led to organic user adoption because the product was a better product, and this led to incredibly high user satisfaction and retention. It was this demonstrable traction, users actively choosing Zoom over established players, and that drove organic growth and positive word of mouth that ultimately convinced investors that this is something that has massive potential, and that led to significant funding rounds later on in Zoom's journey as well.
That's great. Concrete traction is the ultimate validation that can turn initial rejections into successful fundraising outcomes. Now, coming to the chicken and egg problem, how do you get traction when you need capital, but you need traction to need capital?
Yeah, well, it's a real chicken and egg problem, but the key is to prove demand and build momentum without significant external funding. So this is where the founder has to be scrappy, and you have to hack your way to getting some initial traction. You could start with bootstrapping, leveraging some personal savings if you believe enough in your idea to ask other people for money from it. What can you invest from your own end? That might include your savings, your credit cards, or even small friends and family rounds where you share that risk with sort of your core friends and family, and focus on building the absolute minimum viable product that solves a core problem for a specific niche. This allows for rapid iteration and customer feedback without really heavy investment in product development. You can get traction through pre-sales, so customers paying for your product before it's fully built, or signing contracts to pay for your product beforehand. These are all ways where you can get traction without actually having a product. You have to think creatively, but you have to demonstrate a willingness to pay and validate market demand, even if your product isn't fully built out or scaled yet. And you can start building momentum in a community and attract an audience beforehand. So some startups can even validate demand by just building an Instagram channel and making content and getting people to follow and demand for that product to be built out. And these are all things that can help you raise capital. You could build an email list, engage on social media. This organic engagement can signal market interest without really a direct product being built out yet. Early stage SaaS companies often attract users through insightful blog posts about industry problems. And instead of building out a full product, they might manually deliver the core value proposition to your first users. This can help you learn, validate, and gather feedback quickly without heavy development costs, as well as generate revenue in many cases. Imagine a personal shopping service where you manually fulfill initial orders before building a fully automated e-commerce platform. A real life example would be Zappos. The company and the founder initially went to shoe stores, took pictures, and then bought and shipped those shoes after a customer ordered them online. So it wasn't a fully automated inventory system or a partnership with a bunch of merchants. It was just somebody taking a bunch of pictures from their phone and posting it on a site and fulfilling those orders manually. But that allowed them to validate the demand and traction that could later transform into a fully built out product. If you're building something that has a sort of virality component to it or is a consumer facing product, platforms like Kickstarter or Indiegogo can help you crowdfund. And that's a great way to sort of raise initial capital and validate demand simultaneously. Angel investors are also very helpful. These folks are often more willing to take risk on early stage companies with less traction than VCs, especially if they believe in the team and the market. And there's also non-dilutive funding sources like government grants or startup competitions. And at core, any form of early validation that you can get, be it like a few highly engaged users, positive feedback, a handful of early adopters willing to pay, all of these things can help signal to investors that you have something that people want. This initial momentum can demonstrate to VCs that that what you have is not only an idea, but also a business with potential.
Proving real demand and building early momentum to show VCs your startup is more than just an idea. Given how uncertain VC funding can be, how does HBF Venture Accelerator help founders overcome that challenge? What do you offer that truly sets you apart?
So good question. We at the HPF Venture Accelerator also try to solve this chicken and egg problem for founders. We have founders launch their vision, their dream, and our focus is on getting you towards a really built out minimum viable product, an MVP, that can get real traction, which will drastically increase your chances of future success and future funding. We do this by helping founders build their MVP for just $75,000, out of which we co-invest $50,000 into your company for development. And we leverage AI's efficiency alongside our experienced team of developers, designers, and product managers to make sure that your startup's idea or vision can be brought into reality and brought in front of users. All we ask from our founders is to contribute one third of the cost, which is 25K, spread over 8 months with at least a minimum payment of around $3,000. That shows us that you have skin in the game and you also believe in the idea. And this allows us to share the risk with you so that at the end of the day, we can launch your MVP, get real user feedback, and significantly boost your odds of raising venture capital down the line.
Thank you so much, Hassan. Thank you for sharing your experience on how to navigate the complex world on VC investment. And that wraps up another episode of the HBF Venture Accelerator podcast. If you found value in this episode, make sure to just subscribe or follow, leave a comment, or share it with a friend.